We're starting to see a strong rebound right across the board, and under the spotlight today we have Micron technology, which is up more than 6%, and even when we look over the last week, where actually we get quite a lot of red, in fact many companies down double digit, we actually have Micron Tech, one of the rare companies that is up even on the week around 8 to 9%. Now also bear in mind, many investors are still very worried about the trade wars, about the overall economy, and that is why we see investor sentiment in the 20 region extreme fear. But today we want to focus on Micron Tech, which are reporting after the market close on Thursday, and to consider if this company is a buy right now before earnings, which could see them propel maybe towards the upper end of the 52-week range, near their all-time highs at $158. As of today, it's trading in the lower end of the 52-week range. It is up 10% over the last year, and year to date is actually one of the few that is up strongly, near 20%, and over the last 10 years, it has massively outperformed the S&P, up 251%. Now we also get a double buy from Seeking Alpha from Wall Street. In fact, Wall Street's 4.48 near the 4.5 to flip this into a strong buy, so definitely one they believe for strong consideration in the overall portfolio, and it does pay a dividend even on the lower end at around 0.48%. If we were to take a look at the institutions, they hold around 81% ownership. They sold around 10 billion over the last year, but they actually bought around 50% more during the same time frame, and the same to be said in the most recent quarter, Q4 FY24, they bought more than double than they sold, so very clear to note, at least over the last year and the more recent period, institutions very bullish on this company. Now if we just take a look at their latest earnings, this was for the previous quarter, we can see their largest revenue stream is the compute and networking, and that was up 46% just from the previous quarter, with their total revenue sitting up around 12%. But one thing we also love to see from this company is efficiencies on their margin. Gross profit up 3 percentage points, operating profit up 5 percentage points, and we also notice their bottom line also up around 10 percentage points. Now very quickly, if you don't know, they are a semiconductor company specializing in memory and storage solutions, and they focus on developing high performance DRAM, NAND, flash, as well as other advanced memory products for consumer, enterprise and industrial applications, and their products are used across a wide range of different applications, consumer electronics, whether that's smartphones, laptops, gaming consoles, data center and cloud computing, which has only risen over the last few years at an astronomical rate, AI and machine learning, as well as automotive and industrial. If we were to look at this company at the forward valuation in relation to their 5-year average, they do sit slightly higher at 13.4 above 12.5, so you could argue either reasonable valuation based on this model or perhaps slight overvaluation, but as always we don't look at any of these models in pure isolation, and we have another one here with the blue tunnel indicating the expected fair price. Right now the company is sitting at the mid to upper end, so again the same to be reinforced from what we just mentioned, the company does on both of these models look to be reasonably valued. If you were to solely compare them against the sector median of 21, right now they are trading at a 34% discount, but just as we say, some companies do deserve a premium, some companies also deserve to trade at a discount if they don't have as strong metrics as the sector. But what we also want to identify, as we will for Micron Technology, are companies that perhaps are trading at a discount to the sector, but actually are growing and are far more profitable than the overall sector too. We also notice over the vast majority of valuation metrics as well, Micron Technology does trade at quite a significant discount. Now we just want to point out that their most recent quarter, whilst their revenue was up around 12% quarter on quarter, also up 84% from the same quarter last year, they are expecting for the next quarter from next week for their top line to be around 7.9 billion, which is actually lower than the previous quarter. And why we're highlighting this is for those that don't perhaps know, the industry as a whole is fairly cyclical, and we don't always see revenue growing at a straight constant increase quarter on quarter, year on year. We also note when looking at their latest earnings, they did beat on the EPS, 179 above 175 forecasted, but they came in line for their revenue at 8.71 billion. But the real key takeaway here is that their shares at that point were down double digits, and the main reason for this is disappointing guidance, something we talk about consistently on the channel. Whether it's a company in the Mag 7 or a much smaller one, analysts want to see not just in line with guidance, but perhaps even for those that are maybe trading at a severe overvaluation, companies that guide forward and a lot higher than analyst targets. And with the expectation of the 7.9 billion for this latest quarter, we can see analysts were incredibly underwhelmed where they were hoping for just under 9 billion. And one of the things that the CEO did put this down to in that earnings call was that they saw slower growths in part of consumer devices, and they're also experiencing some inventory adjustments. And we can see one of the analysts that was covering this company quite closely said that Micron expects further delay in the PC refresh cycle and cited pockets of elevated customer inventory in the smartphones. And this analyst in particular did keep their buy rating on, although lowering their price target to $130 from $135, which means from this point, as of today's episode, that is still around a 30% gain. And we can also point out when we do look at their revenue split by essential stream, the largest portion, pretty much taking up half, is the compute and network business, which as we just showed you is up 46% just from the previous quarter. Now, great to see over the next 4 quarters, they do expect some strong growth to the EPS. In fact, the next 2, they're expecting triple digit, with the subsequent 2 at high single digit, and they also have a 100% track record, outperforming 4 of the last 4 quarters in comparison to analyst targets. And if they do hit their EPS estimate of $6.84, they're currently trading at a forward valuation around the 14 mark. One thing that you will see with this company is a lot of cyclicality shown through their numbers, and whilst for the ROIC we want 12% at a bare minimum, we do notice here a lot of ups and downs. In fact, in the most recent year it's sat at 2%, and on a trailing 12 month at 7%, leaving a little bit more to be desired for. As we said, we ideally want to see not just 12% at the bare minimum, but also some consistencies in the numbers. Now, their growth is definitely something to get excited about. We do notice an A+ rating, year-on-year revenue 80%, well above the sector at 5, well above their own 5-year average at 4, and the same pretty much to be said for their revenue expected over the next year. 42%, well above sector at 7, well above the 5-year at 9, and we also love the fact that they're anticipating to grow their earnings per share at 38% year on year over the next 3 to 5 years, when in comparison the sector sits much lower at 15, and so does their own 5-year at 6.4. One thing we would say though is their sales growth isn't as consistent as we want. In fact, whilst we do get probably a lot better than 3 to 7% year on year, which is what we want at a minimum, what comes with that is a lot of inconsistency. Some years strong double digit, but also some years negative double digit, with 2024 coming in at 62%, and on a trailing 12 month it does show us that we do anticipate, at least for the full year of 2025, a positive double digit increase to their top line revenue. Profitability also coming in at an A+, although gross margin quite low at 31% when you consider the sector sits at 50, but a lot better than their own 5-year average of 26%. Bottom line coming in at 13%, a lot better than the sector at 4, a lot better than their own 5-year at 7. So what we're noticing with Micron, they're growing at a faster rate than they have done over the last 5 years, whilst also improving their profitability, improving their margins and their efficiencies, whilst also improving their cash generated from operations, now sitting at 10.4 billion for the last year, when on average over the last 5 it has sat lower at 9.1, with the sector nowhere near at 104 million. And we can show you their margins. Whilst they do look fairly strong for the last 12 months, we can see right across the board, whilst majority of the years above the minimum 16%, a lot of cyclicality in their numbers. In fact, 16% is what they hit just on the trailing 12 month, and the same does apply when we do consider their free cash flow margin. And one thing to bear in mind when we've looked at other companies in the semiconductor space, not all of them, some of them yes, but not all of them have that cyclicality also shown through their financial. We will also show you the net debt to EBITDA, where we want below 1.5 for this industry, and these numbers below are the number of years it would take the company to pay off all of their debt net of cash on hand. 0.54 is very low, and that is what we note on a trailing 12 month. 0.38 expected over the next year, so anticipated to improve, but already we can see they do have a very strong balance sheet, something we always want to consider when adding companies to our portfolio. Now, after they did release those earnings, while some analysts did stick with their price, in fact some of them reducing, we do notice the Bank of America downgrading the company, and they particularly pointed this to gross margin, saying that they will have some pricing headwinds. And when we take a look at the actual figure that they've released this company to, we do notice it was fairly significant, trimming it to $110 from $125. And as we said, with the previous analyst rating, they still noticed 30% upside. With this one, Bank of America, we can see around 10% as it currently trades for around $100. And we can see they're pinpointing this to the weakness in PC and the phone markets, and therefore this will ultimately put downward pressure on the memory pricing, especially in the NAND, and is expected for this to continue even in the third quarter. And right now, remember, we are waiting next week to hear the release of quarter 2. Having said all of that, when we're looking at valuations of companies, some are starting to look a lot more attractive in the green, but we get quite a lot right across the board that sits in the red. And in particular, when we look at the semiconductor space, there are only a few that actually are in the green. We have Qualcomm sitting around 13, we have ON Semiconductors at 11.3, but also Micron Technology sitting around 9 to 10, which whilst it doesn't necessarily mean it is a buy, what we have noticed is that the company does look like it is trading at a fairly attractive valuation for us to consider further. Now, before we jump into our own valuation, we just want to let you know we have released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to get severely undervalued stocks for the month of March. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a spreadsheet released just this morning of 97 stocks that Wall Street themselves believe have the most upside right now in the S&P. So click below, you can sign up and read straight away. We then jump into our valuation, where our intrinsic price comes to $120, derived from the DCF model. Now we have the free cash flow year on year, including 2024, and we've gone for a growth rate of 20% moving forwards. We have a low, medium and high figure, but as always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for MU or any others. But based on 20% and the discount rate, we get the present value of future free cash flows and terminal value. Then we add the cash, subtract total debt, get the equity value, divide by the shares outstanding, and we come to 124, which indicates 24% upside. But we'll also show you, for those that believe that is way too high, at 15%, $90, indicating downside of 10%. And for those that believe it should be a lot higher, at the 25% point, $169, indicating 69% upside. Now, typically, we like to take through the medium rate, where today at 20% does come to $124, and then we always start off with 10% for a margin of safety. We execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that today, then a buy at $112, and then we keep going till it's near the current trading price. And what in fact you can see, even with the increase we have seen today for Micron and even the whole week, we still believe there's a 20% MOS, with Wall Street themselves seeing this at $137 on average over the next year, and that translates to right now 37% upside. So let us know your thoughts. Maybe you're someone who wants a higher margin of safety given the cyclicality. At 25%, a buy at $93, at 30% around $87, and at 35% sitting at $81. But as we said, right now sitting at 20% MOS. So give us your thoughts below. Do you see this as a buy, hold or sell? Are you waiting for the earnings? Maybe you're holding, or in fact you're buying before the earnings next week. And don't forget to sign up to the free weekly newsletter. Grab those spreadsheets, come and join us in a Patreon where we do cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.